It's time for our 2-minute drill. Let's bring in Wall Street Alliance Group partner Aadil Zaman. Welcome back. It's good to see you. I'm looking at your stock picks here, and I'm kind of surprised, to be honest with you. Alphabet, Microsoft, new 52-week lows today. You got to tell me a reason other than the fact that they're down a lot to buy them now when someone like Jim Cramer says tech is terrible right now with rates going up.
Great to be with you, Scott. So obviously, Alphabet is down about 30% year to date, and the fear is that, because if the economy slows down, advertising spending is going to slow down, which will impact Alphabet because more than 80% of their revenues come from advertising. We think that at these levels, this fear has gotten a little bit overblown because if you look at the second quarter earnings, year over year, they still reported about a 13% increase in their revenues in spite of a challenging macro environment. And we actually see this as a recovery play because in our opinion, eventually the economy is going to improve. Eventually spending is going to increase on advertising, and this will benefit Alphabet.
I know, but Microsoft, I remember the day that Microsoft came out and warned about FX, right, and said it was going to be an issue. The dollar's only gotten stronger since that day, hasn't it?
Great point, Scott. But Microsoft is a stock on our watch list that we like here because in this environment, it's very relevant. With inflation being at a 40-year high, Microsoft is actually enabling businesses to be able to reduce their prices because their products create greater efficiencies. Microsoft is also a key player in two segments which we see as being relatively recession resilient, which is cloud and cybersecurity. So irrespective of whether the economy goes up or whether the economy goes down, businesses do have to prioritize cloud spending, and that's anticipated to increase about 16% year over year. And Microsoft is a big beneficiary of that because they have 24% of that market.
Okay, and finally, Pfizer. Why do you like it here?
So Pfizer has hit it out of the park with their COVID-19 vaccine and with their COVID-19 antiviral. And because of that, their revenues are at a historic high, yet the stock is down more than 20% year to date. And the fear here is that eventually when COVID subsides, 2023 onwards, Pfizer's earnings are going to go down. We again feel that this fear is a little bit over-exaggerated over here, because Pfizer has an extremely robust pipeline with over 100 projects in clinical development. So we see their earnings continuing to be stable over the years. And Scott, this company pays a 3.5% dividend, which is more than double that of the S&P 500. So this is a stock on our watch list that we really like here.
Talk to you again soon. Aadil, thank you. Aadil Zaman joining us now for our 2-minute drill.